All right, so indeed we can start. Welcome to this webinar of the Center for European Studies and the Joint Research Center of the European Commission from my side and also on behalf of Claudio. We are particularly happy to have with us today Frank Smets, and it's particularly nice to have him here today, which is Europe's Day. And I'm also very honored myself to welcome Frank at this webinar because, as a matter of fact, when I started my career at the European Central Bank many years ago as a trainee, he was my boss with very many layers in between. And I still remember, actually, one day he accepted to come for lunch with me to discuss DSGE modeling versus agent-based modeling. I was a nobody. He was already Frank Smets. So I'm still very thankful for that. Frank will speak about central bank digital currency, which at the Joint Research Center is something that we are very interested in. We are actually working on analyzing the impact of CBDC on the banking system. For example, owing to a possible decrease in deposits, which might have effects on the leveraging, and on bank profitability due to shift towards alternative means of payment. And all of these analyses will feed into an impact assessment on a CBDC legislative proposal from the European Commission. So we are really eager to listen to what Frank will tell us on CBDC. But without further ado, let me give the floor to Andrea. And thank you very much.
Okay, thanks, Lucia. There's not much else to add to what you said. Frank is on leave from the ECB, where he was Director General at DSGE Economics, and he was also the chair of the Monetary Policy Committee. His research fields are monetary economics and applied macro. His work, 2003 work with Ralph Wouters is still the workhorse analysis model for the analysis of monetary policies, and well, today he's talking about CBDC, and I'll give you the floor, Frank. Thanks for being here.
Well, thank you very much, both Andrea and Lucia. Thanks a lot for the invitation, and let me start just by saying that this work is joint work, very much joint work with three of my colleagues at the ECB, Lorenzo Burlon, Carlos Montes, and Manuel Munoz. And that also the views expressed are our own and not necessarily those of the European Central Bank or the Euro system. So this is the overview of the presentation, and let me just jump immediately into the motivation and the main contributions that we think we make in this paper. Lucia actually already kind of gave the motivation. Central banks worldwide have a keen interest since a couple of years in preparing the possibility of introducing a digital currency, a public digital currency or a central bank digital currency. In a recent BIS survey, the BIS found that 86% of central banks are engaged in some type of preparatory work for introducing possibly a central bank digital currency. And the ECB is not an exception. We are going through what we call an implementation phase, a 2-year implementation phase at this point, which should end towards the end of next year, let's say November 2023. The purpose of which is to basically describe the scope and also the implementation of a digital euro, as we call it, a central bank digital currency for the euro zone. So this is not yet decided whether it will be introduced, but it's meant to clarify the scope and some of the technical details. Now, why have central banks become so interested in this topic very quickly recently? I mean, basically, it comes on the back of two big structural changes. The first one is, of course, the structural change in digital technologies, where we have the introduction of private digital currencies, cryptocurrencies, where we also had the initiative by Facebook to introduce a stable coin. And of course, that sort of triggered central banks to look into this more closely. But the other structural trend is that the classical central bank money, which is cash, which is banknotes and coins, in many jurisdictions, the demand for cash is dwindling. And so this combination of those two sectors, basically trends, basically leads to the question, well, is there a need to introduce a public digital currency, a central bank digital currency, in order to preserve the role of central bank money as an anchor and a stabilizing force at the heart of the payment system, and also safeguard monetary sovereignty. So the extreme nightmare or scenario is one where a private digital currency would develop, which would be completely distant from any sort of central bank money from the euro in our case. So that's kind of the main rationale why central banks started thinking, well, we better be prepared in case we would like the case for a digital euro is there. Now, there are many aspects of this question which people are looking at, both in private sector, in academia, and of course at central banks. Most of those aspects this paper has nothing to say about. So there are aspects of implementation. Should it be account-based, should it be token-based? There are aspects of privacy. How private should this new euro digital currency? Obviously, if you want to match banknotes and cash, then it should be very private. At the same time, we also know that central banks have taken initiatives to try to go against money laundering and illegal activities, and so there is a trade-off there. There are issues about international compatibilities, there are issues of financial inclusion, and so on and so forth. That's not what we will talk about, or that I will talk about. What I will talk about is more the macroeconomic implications of introducing a digital euro. And actually, Lucia already said it. We really look into the questions that she said also the JRC is looking into. What could be the potential impact of introducing such a currency, a new technically superior currency to cash, for things like bank intermediation, for things like the transmission mechanism, and more generally, the working of the macro economy. And of course, for the Eurozone, this is very important because although non-bank finance is becoming more and more important, we are still very much a bank-based economy. So we have a bank-based financial intermediation. And now ECB has already recognized the potential challenge of introducing a CBDC from that perspective. And the people that are in charge of this project, which at the board level is Fabio Panetta, and at the senior staff level is Ulrich Bindzeit, have already written about ways in which one could try to mitigate the risk of bank disintermediation, for example, by limiting, setting a threshold or a limit on the use of CBDC. The amount that has been floated is 3,000 euros per person or per household. Ulrich has also written about the possibility of introducing a tiered system whereby you could use it freely and at zero interest rate until a certain amount, and then after that there would be a penalty rate on it if you want to hold more than that limit. So there are different ways in which you could think about limiting the use of the digital euro in order not to undermine our bank-based financial system. And why is that? Because of the perceived substitutability between deposits and central bank digital currency. So if you indeed introduce a digital euro and basically households and firms shift their holdings of euro from bank deposits to the central bank digital currency, again, which in one form could be actually an account with the central bank. This is unlikely to happen that way, but that is one way of looking at it. Then, of course, that could lead to some disintermediation. Although I should say that in the literature, there is also a few papers, and particularly one important paper by Jonathan Chu and co-authors, that has argued the opposite, that because banks have oligopoly power in the market for deposits, so which means that they kind of mark down the interest rate on deposits, introducing actually a competitor would actually increase competition in that market and may therefore actually lead to more financial intermediation. This is not what we will have, but I just want to put it up front to say that there are different results in the literature. So against that context and motivation, let me very briefly say a few words about related literature. I mean, on the empirical side, actually, on the empirical side, there's very limited work, obviously, because in the advanced economies, central bank digital currency have not been introduced yet. What is available more and more is survey-based evidence, where households are being asked, if this type of currency would exist, would you use it? How much would you use it? And so on and so forth. So it's trying to elicit the demand for that currency as a function of certain characteristics by just asking people. There is a bigger literature, and it's growing very fast, which uses model-based analysis. And there, so macroeconomic models to try to introduce and look at this question. And so there are three types of models that are already there in the literature. One, which is the more fundamental one, are so-called new monetarist models, a la Lagos and Wright. This is not surprising because obviously no money is there for its payments function, no, to address the double coincidence of wants. And these models try to microfound the use of money in a context where transactions are bilateral. And so there's a few papers there, including by my colleague Katrien Assemacher in that vein. So they really try to microfound the use also and the demand for digital currency as opposed to other monies. A second part of the literature looks at bank-run models, a la Diamond and Dipfig, because of course one of the fears is that if there is a widely available central bank public and therefore assumed credible digital currency, when you have financial stability risks and when there are fears that, say, the banking system would collapse, then that may actually lead more easily to a bank run, which would then actually make the financial stability risk materialize. And so a number of papers, including by Keister Monet, Fernandez, Villaverde, and others, have looked at that in those type of models. And the third type of models is the one that we will use, which are new Keynesian, or many of them are new Keynesian, but DSGE models. And so in those models, it's more about how, if we introduce this new currency, how does it affect the transmission of monetary policy? How does it affect financial intermediation? So these are typically DSGE models with obviously a banking, a financial intermediation sector. So our paper very much fits in this last category. Now, there are many others, and actually one paper that I would like to highlight here is the paper by Brunemeyer and Niepold that appeared in the JME, because it basically puts forward an equivalence result. It basically derives like a Modigliani-Miller theorem for the introduction of central bank digital currency in many contexts where frictions are not very important, it shouldn't matter to introduce a digital euro. I think that's very useful because it's sort of the starting point that you think, and it also makes clear that if you want to look at effects, you have to think about, you know, where are the financial frictions and what type of frictions does money try to and finance try to overcome. No, because if you don't do that, then you will get close to equivalence, and it shouldn't matter in the end how banks finance themselves, as long as they can find the finance and the markets adjust. Okay, so where does our paper comes in? Basically, it provides, there's three main contributions. First, we provide some first empirical evidence on the likely impact on bank stock valuations and lending by exploiting the announcement effects from news about the digital euro. So we will code the communication of the ECB with respect to the digital euro, and then look at how bank stock prices have responded to that. Try to see how the bank stock price reactions differentiate across characteristics of those banks, and also see whether that actually had an impact on lending. So it's like, obviously, because we cannot know, we try to use the wisdom of the crowds, the wisdom of markets, to see what do we see there? Do we see evidence that the markets are concerned about this possible substitutability between bank deposits and central bank digital currency, and the risks it poses for the bank-based intermediation system and disintermediation? The second contribution is that we develop a quantitative DSGE model of the euro area economy to investigate the macroeconomic impact of introducing such a euro. And that model will, of course, replicate, I mean, not in an exact quantitative sense, but in a qualitative sense, some of the results that we found from this announcement effect study. It's the biggest, the model is quite standard. It's basically sort of a Jacobiello AER 2004 or whatever model that that we sort of tweak to introduce central bank digital currency. The biggest issue or problem or challenge with this model is to have a good calibration, no? Because obviously we are interested in no quantitative results, no, and impact assessment, as Lucia said. And for that, no, we want to have a model that actually fits the most important features of the euro area economy in terms of financial intermediation. And obviously those features have changed. So the financial system looks, and the central bank balance sheet looks very different now than it did 20 years ago. And so some choices will have to be made, but that's what we try to do. And the important thing is that that we want to emphasize is, and maybe not surprising, that it's important to have a quite detailed, I mean, it's still a stylized balance sheet of the banks, of the financial intermediators, and also of the central bank, obviously, because also the way the central bank balance sheet reacts will have implications for the macroeconomy. And then the third contribution is that once we have that calibrated model, we perform welfare analysis of simple central bank digital currency quantity and interest rate rules. And of course, the purpose of this is to highlight that there are welfare costs and benefits, and that there's a trade-off. And we find that, again, depending on which quantity or interest rate rule you focus on, there is sort of an optimal, not only an optimal quantity of CBDC, but also an optimal way of responding to the business cycle. So there's an issue both of steady state and of stabilization around that steady state. Okay, let me, so I won't go through the findings immediately. You'll have to stick with me till through some of the details. I usually, in the last two, I mean, this is the third time I present this paper, so I should say it's still very early, so all comments very much will help. But in the first two, I tried to give sort of the bottom line at the beginning, and the problem is then there was no time at all for the rest. So let me try this time the other way, and let's see whether you tell me later whether it works. So let's go to these three things. First, the empirical evidence. Just check. Okay. So this is what we do. First, three parts. We first have an event study. How did euro area bank stock market returns react to digital euro news? Secondly, we do cross-sectional analysis of those reactions. What bank features explain the cross-sectional distribution of abnormal returns around digital euro events? And then third, we use then that as a treatment to ask the question, did it actually have an effect on lending? So this is like a diff and diff impact assessment. How did bank lending conditions react to the sensitivity to euro digital notes or digital euro notes? The event study, I mean, it's quite standard, so I don't think I need to go through any of the details. We basically estimate Fama French type of regressions, so where the return on a particular bank stock is regressed on a number of Fama French factors, plus a list of dummies that capture communication by the ECB. So this is speeches by Panetta, Bilza, the president, or publications like a VoxEU, VoxEU or a blog by the ECB that deal or announce certain aspects of the digital euro project. So what we're after is the gamma EB, the red coefficient that captures how these excess returns responded to this news once controlling for other normal factors that determine stock prices. The second part, then we take those gamma EB, so we will have 134 banks. These estimations we go from 2007 daily to 2021. So we have 134 of those estimated impacts, and we can, and again, that will be actually a time series. Then we can look at to what extent we can explain different reactions across banks. So which bank characteristics are associated with these, with a strong sensitive, strong negative, or strongly positive sensitivity. So let me just summarize the results rather than giving you the kind of the tables with the estimates by this graph, which basically shows you the cumulated gamma parameter. The black solid line is the average across all those banks. And what it shows is that this, so before the first report on the digital euro, which is the first vertical line, was announced, I mean, basically there was no reactions there. But then when the report was announced, so this was the first important announcement, you saw that there was a negative and a significant negative response of bank excess returns. That stayed negative until Ulrich and Binzeil and Panetta started talking more about some of the risks associated with introducing digital euro and some of the limits or the ways in which we can limit those risks, in particular the 3,000 euros. So that's what is called the second vertical line, where further details was given that the use could be limited, and also the ECB sort of made clear that it is aware that this is a risk and that it will kind of deal with it. And you see that then this effect again becomes almost zero, and sort of significantly negative. Now, the other thing that, so there is a response, but it depends on how the digital euro is perceived to be implemented. That's what we, so a negative response for banks, but it depends on how it's introduced. Now, what the other lines show is how banks with different exposure to deposit funding, different basically deposit funding ratios respond. So the dashed black line is basically the average of banks that have a higher than the median deposit to asset ratio. The dotted grayish line is the complement. No? So you see a big differentiation between banks that mostly rely on deposit funding and those that don't. And actually for those that don't, you see actually even a positive response, which our model has nothing to say about, in the sense that we can really generate, or well, we could generate a positive response, but not necessarily based on deposit funding. But we do think that it has to do with the fact that, of course, introducing a digital euro potentially could actually strengthen the banking sector if it's done in a way that is complementary to the banks. The banks are also part of, let's say, the custodians of the digital euro, because it probably could help them to also compete better vis-a-vis big tech, which is the real threat for banks. But anyway, so that's sort of a side remark. So the important conclusion from this result is that the one, and I should say in the regression analysis, we look at many different characteristics. No? So I mean, you can have a look at the paper. We have like more than 10 different characteristics. I mean, size, I mean, leverage, profitability, different bank. The only one that is significant is deposit as a ratio of total balance sheet. So that's the only one that matters. And so the way we interpret this is that, at least in the perception of the investors in those banks, it's really this substitutability between deposits and central bank digital currency that is a complicating factor for the bank. So if a bank relies a lot on deposits and the central bank introduces this alternative, it may lose its deposit funding. That will increase or reduce its interest rate margin and potentially reduce profitability. And so that's what we will also, and of course that's what is also generally talked about in many of the reports, but you kind of see it now in action also in the financial markets. Now the last part, and that's a little bit of a heroic step, we then ask the question, well, is there any evidence that it actually matters for lending? No, is it the case that those banks that are perceived to be more vulnerable to introduction of digital euros also, even in anticipation, start reducing lending? I mean, it could be because of anticipation, but it also because, of course, when the stock market drops more than for others, cost of funding goes up too. No, so there's a cost of funding, direct cost of funding effect. And so for that, we basically do this third part, which is a diff and diff impact assessment. So we now take on the left-hand side the change in lending following the announcement of the news and the impact of that news on each bank. And we regress it on how sensitive that bank is to that news. So that's this Gamma B October 2020. And the reason why we can be quite confident that we really capture the effect of this sensitivity or this elasticity to the digital euro news is because we have this huge unaccredited data set, so which are individual loans, pairs between a bank and a firm. And so we can control basically for all types of demand factors just by including firm dummies. So that's basically Kwajamian typical strategy that you use a firm that has bank relationship with two banks, one bank that has been subject to this treatment of let's say introduction of digital euro and is sensitive, another one that's not, and you see whether that bank, so for the same firm, lending behavior changes. And what we find is it does. No, so there is actually a significant effect on lending, and it is. I mean, it's not huge, but it's not insignificant economically either. The impact of a 1 percentage point decrease in stocks due to this digital use leads to a fall in lending of about 0.4%. Anyway, I mean, I don't want to make too much about this result, but this is just to say that if you look at this evidence in the financial markets, then actually there is some evidence that, again, deposit funding is key and that it matters, for the actual the intermediation of the banks. Okay, let me then go to the model, the calibration, and some of the transmission mechanism. So as I said, it's sort of the core is Iacoviello's AER 2005 model. So they're savers and borrowers with different discount rates. And the banks are basically the institutions that intermediate between those two agents, to the impatient households, and they're also entrepreneurs and the savers. Now, the savers are the ones that obviously invest, and they are the ones that also have a demand for money, like or liquidity providing assets, which are in our model deposits. So this is what the banks issue, central bank digital currency. This is this new, technically superior form of public money, and then the existing cash. So these are the ones that enter in sort of the utility. So it's a money in the utility type of approach that we will be using, which is, of course, a shortcut. It's somewhat ad hoc. In principle, you would like to have one of the micro-founded, like the Lagos Ride type of models to micro-found this research. We don't do that. We take this shortcut, like many models in the literature do, to see what the macroeconomic effects are. The banks intermediate between patient and impatient households. So they collect the deposits from the savers and they loan it to the borrowers who use housing as collateral, like in Iacoviello, and also to entrepreneurs who use basically capital. So that an example would be commercial real estate to do the same thing. So there's capital accumulation also in this model. Now, the other thing which is somewhat different from the Iacoviello model is that on top of that, there are liquidity requirements. So for each deposit, banks are, like in reality, are asked to hold some reserves with the central bank. And secondly, there's also borrowing from the central bank against government bonds as collateral. So the funding side of those banks will be basically deposits and borrowing from the central bank plus equity. And equity is needed because there are capital constraints, like in Iacoviello. And so on the asset side, you will have loans, you will have some reserves, central bank reserves, and then there will be government bonds, which are needed in order to as collateral for central bank borrowing. So that's sort of the kind of the balance sheet structure of the banks. I will not go through the equations. I mean, more or less, I said already what are the important elements. So you see here with the savers or the patient households, the main new element is this ZT, which enters the utility function, which is the liquidity providing services by cash, by CBDC, and by deposits. And of course, one of the key parameters will be the degree of substitutability between those liquidity providing assets. And of course, we will use in the calibration the existing spreads between deposits and cash and reserves to now calibrate that elasticity, and also the shares. The other element that's useful to highlight is that what's, of course, the difference between M, cash, and central bank digital currency in our model. In our model, I mean, there's some imperfect substitutability, which has to do with the fact, that for, I mean, M, it's something that you hold in your hands. CBC is a number on the computer. So, I mean, it's not perfect. Different people will have kind of different connotations with the fact that something digital versus real and so on. So there's imperfect substitutability there. But more importantly, we assume that there are basically costs of increasing costs of holding cash. So that has to do with insurance, that has to do with carrying costs, and so on and so forth. So that's what's there, the FNT. And of course, that means that when you introduce central digital, and there will immediately be a benefit just from the fact that you can substitute cash for central bank digital and get rid of some of those costs of carrying banknotes in suitcases. I mean, the other thing is the banks, and again, I will not go into detail, but the bank managers, they basically try to maximize, as is common in this type of approach, distributed dividends, subject to quite many constraints. And I think this is also the reality of a bank nowadays, that a regulated bank, that they have to satisfy many constraints. First of all, balance sheet. So these are the items that are already mentioned. There's a cash flow restriction. I mean, in this model, equity, which is needed in order to give loans, because of the bank capital constraint, is internally generated. So it depends on profit. So what is not distributed, the profits that are not distributed, will lead to a higher equity, which then allows to an alleviation of the capital constraint and have more borrowing. So any shocks that affect profitability will also affect the ability to lend. So that's basically three, this capital constraint. And in the general thing, I mean, you can have different capital requirements for loans to the households, loans to the firms, for bonds, and for reserves. In our calibration, we will assume sorry, that there's no capital requirement for bonds, government bonds, and reserves, but there is a capital requirement, and a higher one for firms than for loans to households. Sorry. Then there will be a liquidity reserve requirement, like in Brunemeyer and Kobe. Again, this also reflects some of the reality. And finally, there will be a central bank collateral requirement. So the banks can borrow from the central bank, but they have to put up some collateral. And in the baseline, we'll assume that collateral is government bonds, and that the theta B, so is a very high one. It's basically almost one. So you can almost 1-for-1 use bonds to get not fully one, but close to one for central bank currency. And so when a bank, in that case, when a bank loses deposits and wants to fund more through the central bank, it will actually increase its demand for bonds because it needs more collateral. And so this is one of the channels that will also be working. I mean, government, there is just a fixed amount of spending as a share of steady state output. The usual constraint, I mean, the only thing I want to highlight here is that there's seigniorage, so central bank profits will, of course, enter the budget constraint. This will actually be important because, of course, one of the things that happens when the central bank introduces a new currency where there's a demand for it, it actually will increase its seigniorage, its profitability, which means that the government intertemporal budget constraint will be relaxed. And so if you have a fiscal feedback rule, as is the case in our model, where taxes can actually be reduced when the debt is lower, then that can have a stimulating effect, which offsets some of the other effects. And then for the central bank, again, it's a bit more complicated than in your standard new Keynesian model, where you only have one interest rate. In this case, you have a lending rate to the banks, which is what we model as a Taylor rule. So the central bank sets the lending rate to the banks as in the form of a Taylor rule. Then there's a deposit facility rate, which is the interest rate on reserves, which is just a markdown on that lending, the borrowing rate. And then finally, there's also potentially this new interest rate on the CBDC. In the baseline, we will just assume that there's a fixed quantity of CBDC. With that will come an implicit interest rate, which actually will be negative in our calibrated model. Why is that negative in equilibrium? It has to be negative in equilibrium because obviously there's this other cash, MT, which has zero interest rate as is usual. And given that central bank digital currency is sort of superior, I mean, in equilibrium, in order for people to hold less than cash, it will have to be penalized. But the point here is that you can look at all types of quantity and interest rate rules. You can also, one of the things we look at in the paper is what would be zero interest rate CBDC rule mean? No, so you basically treat it like cash. How high would the demand be in that case? What type of crowding out do you get in that case for cash and deposits? I will not go through the calibration. I mean, there's many parameters here, and you can discuss many of them. We basically do 3 steps. One, a baseline of preset parameter values, just looking at the literature, and these are some of the standard ones. Secondly, a number of parameters, particularly those that have to do with the new elements and with the financial sector to match basically steady state ratios and steady state interest rates and interest rate margins. And then the third set of parameters, which are mostly the sigmas, the standard deviations of the shocks, in order to match some of the moments, the second moments of the economy. And so, I mean, if there's time, we can discuss a bit. But let me just show you what, after the calibration, what the central bank and bank balance sheet looks like. So these are basically the balance sheets of the banks and the central bank. And so, I mean, I don't need to repeat what I already said, but you can sort of see how our calibration tries to match some of the broad composition of banks and central banks. So that there is 80% of deposits on the liability side of banks, that there is a share of cash and reserves, which is around 50-50. I mean, I should say, sorry, I talk too much, too loud. You can also see what in equilibrium the interest rates are, and again, that will be important then to find the quantitative effects of the disintermediation channel. I mean, you see that the interest rate margin is around 3%, which was the average one over the last 2 decades in the euro area. You see that central bank funding is more expensive than deposits, which will be costly, when banks need to substitute from deposits to central bank lending, and so on and so forth. So how does transmission work in this model? Basically, this is the new balance sheet. If you introduce fixed supply of central bank digital currency of 25% of GDP. So that's just to illustrate. Now, what this does on the central bank side, of course, there's this new liability, which is CBDC. So that increases. But because of the substitutability with cash and deposits, you see that cash, liability of the central bank drops, and deposits, they drop. Now, for a bank, what that means is that, I mean, deposits are very cheap funding. It's I think it was 2.4 or 2.3% in the first steady state. Now it needs to increase its central bank funding. So that's what you see, the blue line that goes up. The drop in cash and reserves is less than the increase in CBDC. So the overall balance sheet of central bank increases, central bank funding increases, which means that banks will also have to have an increase in the demand for collateral, government bonds. So government bonds increase. And on the asset side of banks, basically reserves will drop, because deposits drop, and loans will drop because they have to substitute for government bonds. Plus, they are now less profitable, the banks. And you can see why they're less profitable. No, basically on the liability side, they have to use more expensive central bank funding, and on the asset side, they have to invest in less profitable government bonds relative to loans. So interest rate margins of the banks will fall, profitability will fall, and that has then a negative impact also through equity accumulation, which will fall on loan generation. But that's not the only part of the story. So what I'm now mentioned is sort of the upper part of this picture. So the fact that it leads to reduced bank profitability, somewhat smaller bank balance sheets, bank intermediation, and lower growth. There's another part in general equilibrium, which is that, of course, the central bank's balance sheet increases and becomes more profitable, because central bank digital currency is very cheap liability for the central bank. And again, in equilibrium, we'll have actually a negative interest rate. Those seniorage profits go to the government, and so this leads to a fiscal expansion in our model, because there's a reaction function that may actually stimulate the economy. And actually what we find is that the balance between those two very much can depend on the type of shock that you're looking at, and also obviously the fiscal rule. If this fiscal expansion is very effective, for example, because you give all the profits and the lower taxes or the transfers to the borrowers who are constrained and who basically want to spend it, then actually this positive effect can even offset the negative bank disintermediation effect. But in our calibration and in steady state, we do get a relatively small negative level effect. And so this is what this graph shows. Again, for different increases in central bank digital currency. On the horizontal axis, you go from 25% to 45% to 63%. 63, why? Because that's actually what the equilibrium would tell you if you had a zero interest rate policy. So if you set interest rate to zero on central bank digital currency, then the demand for that asset would be in the order of 65%. And see, as you go from zero to more supply of central bank digital currency, of course, cash and bank deposits fall, because bank deposits fall, reserves fall, central bank profits go up, central bank assets, the balance sheet of bank, goes up, government debt holdings by banks goes up because they need it as collateral for central bank lending, present value of banks goes down, bank loans goes down, quarterly real GDP goes down. Again, not by big numbers, but not by nothing either. No, we're talking here from minus 0.4% quarterly real GDP to a bit more than minus 0.6. I mean, you can look at. Oh, I see. I need to stop. I mean, you can look at sort of temporary, these are permanent supply shocks of CBDC. You can look at temporary shocks. Some of the results are a bit different. Actually, in this case, we get positive results because of the fiscal effect. But let me not talk about that. Let me spend 2 minutes on the welfare analysis. So what just to tell you what we do, and then you can look at the paper to look at all the details. So so far, we just looked at what if we just have a fixed supply from zero to some number of digital currency. But of course, what digital currency does, it introduces this possibility to also use it for stabilization purposes. And so you can have quantity rules, you can have interest rate rules. What we find in Gen, and these are the 6 that we look at in the paper. Again, I don't have time to go into the details, but let me just summarize the results by showing the welfare analysis in this picture. So this is for the quantity rules. And so let me just highlight 2 or 3 findings. I mean, the first one is that obviously the ones that benefit most from introducing CBDC are the savers, because I mean that basically it enters directly in their utility function. So that the more the better. I mean, there will be some satiation level at some point, but not in the range that we're looking at here. So the welfare of savers just increases as you increase the supply of CBDC, which is what is shown on the horizontal axis. It's really for the borrowers that there is a trade-off. And you see that there is an optimal level. And the reason why there is this trade-off is because they benefit on the one hand from the fact that by introducing CBDC, you can, and this new policy instrument, you can actually stabilize the economy better, which is good for borrowers also, because particularly they are sensitive to the business cycle. But at some point, as you start increasing CBDC even more, they start being hurt by the fact that the banks are hurt and that the bank disintermediation drops, particularly in steady state, so permanently. So there's this optimal level, which again, if you look at the black line, now of course the problem in the heterogeneous agent model, like 2-agent model, is how do you weigh the 2 agents? We have 2 welfare functions on the left-hand side, on the right-hand side. Again, it depends a bit on who you weigh more. But if we just focus on the left one, which is equal weight or weight according to weight in the economy, 0.5, you have a sort of an optimal level of about between 25 and 30% of quarterly GDP. And the last point I want to highlight is that having a more counter-cyclical rule, so where the supply of central bank digital currency falls as the economy booms, or the reverse, leads to higher welfare. So that kind of boosts this stabilization effect that I talked about, which again mostly benefits borrowers, but not only borrowers, and increases the optimal supply of central bank digital currency. In the paper, we do the same for interest rate rules. More or less the same results are. Overall, we find that interest rate rules, because they are more counter-cyclical, actually perform better than quantity rules, which is not something that's dissimilar to what you find in the standard monetary policy literature. Okay, let me just stop and say that in the last part of the paper, we then do quite a bit of robustness analysis to see, obviously, how do these results depend on many of the important parameters. I mean, what are important parameters in this model? Central bank policy, collateral requirements. Obviously, if you increase or ease collateral policy by, for example, which in the baseline we haven't assumed, assuming that loans can also be used as collateral, then you will reduce this disintermediation effect because it's much easier. You get closer basically to the Brunemeyer-Niepelt result of equivalence. The other one that's important is reserve requires. The higher, if there are lots of excess reserves, and central banks can actually just, banks can just substitute funding by reducing the amount of reserves on their asset side, then again, the effects will be less. And of course, this is the situation in which we are now, where there is a huge amount of excess reserves. And so in the current context, introducing central bank digital currency may not have much of an impact on bank profitability, actually may lead to the opposite result. And then again, we look at different degrees of substitutability, different degrees of deposit funding, and other parameters to show how the optimal quantity changes. And most of these results are quite intuitive. Again, the greater the substitutability implies a lower optimal CBDC because it's very substitutable, then actually deposit fall will be large and the costs may be higher. And so you want to reduce those costs by restricting the supply of CBDC and so on and so forth. Let me apologize for rushing and also going over the allocated time and see if there are any questions.